Warren Buffett's interpretation of financial reports. Number 57. The right time to buy a DCA business. The price you pay directly affects the return on your investment. Warren is looking for a DCA company as being a kind of equity bond. The higher price you pay, the lower the rate of return on earnings over a 10-year period. For an example, refer to number 56. The value of a DCA company. Cash is blood to every business. Warren is looking for the cash flow surplus. Retained earnings. The lower price you pay for the DCA, the better over the long term. It's all about the long term. When to buy. In a bear market, the DCA may seem expensive to other bear market bargains. In the long run, they are the better deal. A buying bargain can appear when a DCA business is experiencing a one-time problem that is solvable. The key is the problem is solvable. Stay away from the super business in the height of a bull market, when they are trading at a high price to earning ratio. Another business tip from Learn Accounting Fast. Next, when is it time to sell?